Let's start with your top tax tips, because it's the end of the year. The final quarter of the year is a big time to tax plan for the next year. Sean, why don't you take it away with some of the tips you have for our late starters or in general?
So one of the big ones this year is the donor advised fund. Now, you have to be charitably inclined, but we had this one big beautiful bill back in July, and one of the underreported aspects is this sort of mini revolution in charitable giving. So what they're doing is starting next year, they're changing some of the rules. Two big ones. There's a small non-itemized deduction for cash charitable contributions up to $1,000 a person starting next year. And the one I want to touch on from a planning perspective is a haircut. So what they're saying is you have to take a look at your adjusted gross income and figure out a number that is 0.5% of that. So if you made, say, $200,000 of adjusted gross income, quick math on a podcast, always dangerous, but I believe that's $1,000. So if you're going to deduct your charitable contributions starting next year, in that example, you would just slash $1,000 from the otherwise allowed deduction. So what that means is 2025 might be a really good year if you're charitably inclined to contribute, particularly appreciated securities, and we have an up stock market, appreciated securities to a donor advised fund, take the full deduction this year, okay? And then you can move forward. You could use that in 26, 27, 28 to make your charitable contributions, but you've accelerated a deduction into a year. You can get 100 cents on the dollar of that deduction. So if you're charitably inclined, donor advised fund this year might make a lot more sense than it might make, say, next year.
Yeah, I'm a big fan of donor advised funds. I hold mine at Fidelity, which does a great job. Vanguard has them. There's other institutions like Daffy, not to diss any other folks, but we lumped 3 years of contributions of appreciated stock into a donor advised fund. Nobody pays tax on it. And I use it as a giving plan for our family, where throughout the year we accumulate smaller donations. My family votes on what is most impactful to us, and we make bigger donations on Giving Tuesday, and they'll inherit that. And so you can create a giving engine with a donor advised fund that outlives you and grows with your family. It is a great tool to give, which some view as the first part of a financial plan. So I completely agree. Cody, what about you? You got a tip for us?
Yeah, so I'll add on to that. Another thing in 2025 is not everybody will be able to itemize their charitable contributions this year, but using the donor advised fund, like stacking those multiple years of contributions into one tax year, is also going to be beneficial because of the new $40,000 state and local tax cap. That was at $10,000, now it's at $40,000. There are some income phase outs, but those phase outs are actually pretty high, so it'll be less concerning to our audience. The biggest thing, really mirroring Sean there, is that for a late starter, year-end tax planning is deduct, deduct, deduct. I think Sean even put 3 exclamation points on that in the book for the late starters chapter, because when you think about a late starter, they really shouldn't be worried about being crushed with taxes and retirement. I mean, we don't think anybody should be worried about being crushed, but especially not the late starter, because their biggest emphasis is on sufficiency. Their priority is saving and investing. And how can you save and invest more as a late starter is by, if it's possible, maxing out those pre-tax retirement plan contributions through work. If you don't have access to those retirement plan contributions at work, but you still have earned income, maybe you're self-employed, et cetera, certainly there are some self-employed options, but also you might even consider, if you're able to, deducting traditional IRA contributions depending on your income. So the more that you can deduct this year, the more actually opportunity you have to save and invest with those tax savings. There's a common misconception. People say, if I'm limited to how much I can contribute to a 401k, whether it's traditional or Roth, if I contribute to the Roth, that'll end up being like a bigger contribution because those future distributions will be tax-free. But you have to keep in mind, like, for example, contributing, let's say $20,000 to a traditional 401k versus $20,000 to a Roth 401k, the Roth actually involves requiring more income to start. So whenever you contribute to a traditional 401k, just keep in mind that, like, it's really up to you to save and invest the tax savings. So take advantage of those deductions, but also utilize those deductions by increasing your contributions. Also, on top of 401ks, 403bs, 457bs through your workplace, don't forget those catch-up contributions, right? So you have the normal catch-up contribution of $7,500 for being over 50 or older by the end of the year. But also they have these kind of fun super catch-up contributions for those, 60 to 63.
Yes,
and so, right. So on top of the $7,500 that I mentioned for like standard catch-up, also another additional $3,750 on top of that for those unique ages. But all in, you can see that late starters might be able to be contributing $31,000 or $34,750 to those traditional retirement accounts, which also gives them, by deducting those contributions. And by the way, on top of that, the HSA, Jackie's favorite, those health savings accounts. Yeah. I would just say that the priority here is deducting as much as possible in your late starter years so that you can save and invest and get to retirement even faster. And yes, like you will have to pay taxes along the way, or maybe not, right? Maybe we'll get into ways you cannot pay taxes in retirement, but really focus on contributing, saving, and investing even more through deductions.
Yeah, I completely agree. And I'm turning 60. I'm in that sweet spot. My wife's in that sweet spot. We're both individual contractors and have solo 401ks, which allows us to catch up. This is more for high income earners, but I can put away over $80,000 pre-tax into my solo 401k with this catch up and super catch up. And honestly, I don't want to give that up for the next 3 years, nor does my wife. So there's fantastic opportunities for everybody, but high income earners that are independent contractors or 1099 contractors should really pay attention to this. And Sean wrote the book on solo 401ks. So Sean, give us your next tip for the end of the year planning for late starters or in general that's important, a blind spot we might miss.
Well, so what I'm going to mention is just IRA contributions. So we were talking about workplace retirement contributions, and they're great. One of the good things about this one is you can wait till next year. And in fact, you might want to wait till next year. So what I'm talking about here is a Roth IRA or a traditional IRA contribution. And it's $7,000 this year. It's $8,000 if you're 50 or older by year end. And the nice thing with this is the contribution deadline is April 15th of 2026 for 2025. Now, if you do the contribution in 2026, you just got to make sure on that internet portal for your brokerage, just make sure you do the drop down and say, this is for 2025. The default is it's for the year you made it, right? So just make sure it's very clear, okay, this is a 2025 contribution, even though it's January, February, or March. Why might you want to do it that way? Well, if you're listening to this in December and you're like, I don't know what my income is ultimately going to land at for the year, it could be helpful to, all right, just wait. You don't have to rush this one. Wait until February, March, do a draft of your tax return, self-prepared or with a paid preparer, and you say, okay, where's my income coming out? And that can inform, hey, do I qualify for a Roth annual contribution? What does this all look like? And so that's one just to keep in mind. It's a little bit of a hurry up and wait. Now, not too long. April 15th, the deadline there. But that could be an effective one. And for a lot in the audience, even though Cody and I, and we'll talk about the book, we generally advocate for these traditional 401k, 403b type contributions at work, at home, we often advocate for Roth contributions to an IRA. And the big reason there is the ability to deduct that IRA contribution when you do it to the traditional, much more limited. Now, there are going to be some people who can deduct it, and it's worth considering. But a lot of the audience maybe is in their higher income years, in their, say, 50s. You said Gen X, right? So maybe you've gotten to a salary where, okay, you're doing great. I mean, you're still catching up, but the income number this year is pretty good, and you've kicked above the income level to deduct an IRA contribution. So there, a Roth might make a lot more sense.
Don't forget about the backdoor Roth, right? For those higher income earners where you don't meet the income limits. There is a way to do that.
Yes. The backdoor Roth is a two-step transaction. I've written about it extensively on my blog, and we're recording this in October. I could tell you in December, I've got 2 more backdoor Roth blog posts coming out in anticipation for the 2026 backdoor Roth IRA season. But the one thing I'm going to mention there is people ask, well, what's the deadline for a backdoor Roth? And the answer is there's no official deadline for the backdoor Roth. But remember, the backdoor Roth is a 2-step transaction. It's a non-deductible traditional IRA contribution followed by a relatively close in time conversion of that amount and any growth to a Roth IRA. And the step that has a deadline is that first step, the non-deductible traditional IRA contribution. That has to happen by April 15, 2026 for 2025. And that coding thing I mentioned, just make sure to code that contribution as being for 2025. And then the last thing is the backdoor Roth is not for everyone. The main thing you got to look at is the other accounts you have. If you have other traditional IRAs, SEP IRAs, simple IRAs, generally speaking, the backdoor Roth is probably not going to be available in terms of doing it in an efficient and desirable way. So what do? That person probably just says, okay, I'm going to invest this $7,000 or $8,000 in a taxable brokerage account. And that's not that bad of an outcome. But anyway, so you just got to look at your own situation. But absolutely, the backdoor Roth can be a desirable path.
So guys, quick question and sort of clarification on deadline. So what other accounts have the April 15th deadline versus the end of the year deadline?
So just like the traditional Roth IRAs, the HSA, the health savings accounts, also has the April 15th deadline. Without getting into too much complexity, I will say that contributing to an HSA through payroll is a better bet, just because you're avoiding the FICA, the payroll taxes on that contribution, as well as the income taxes, so that the Medicare, Social Security, up to the wage base. So that's actually one of the add-ons I had here for year end is, one, if you have any year-end bonuses, you might want to look at your plan, your 401k, 403b, et cetera, to see if that's considered what they call eligible compensation, which means maybe you're behind on maxing out your contributions through your 401k. Maybe if you have a year-end bonus, just see, hey, is my elective percentage for contributing to my 401k, will that also include my year-end bonus as eligible compensation? Because that might help you get over that, just max out to the top of that. Like Sean said, if you might want the IRA and the HSA, if you're kind of saying, hey, which one should I focus on? Really, the year-end deadline is on those workplace retirement plan contributions, assuming you're an employee, right? If you're self-employed, you have some extra time to do those things. But if you're like a W-2 employee, you want to prioritize focusing on your workplace retirement plans. And then April 15th, that is the deadline for your traditional Roth IRA contributions and your HSA contributions.
We hope you've enjoyed this episode of Catching Up to 5. We would appreciate it if you could also leave us a 5-star review to help our message reach others.
And while we are financial educators that love to teach, remember that our content is for general education and information purposes only. We are not providing financial, legal, or tax advice. Always do your own research or consult a professional before making important decisions.
So Jackie, we'll see our audience next time on Catching Up to 5. Cheers.